How speculation and short-term gains are distorting the housing market. Speculation and the pursuit of short-term gains have had a substantial impact on the housing market in recent years. This trend is distorting the conventional dynamics of supply and demand, resulting in inflated property prices and a variety of economic and social issues. Here is a comprehensive examination of the impact of speculation and the pursuit of immediate profits on the housing market. Artificial price inflation. Speculators frequently acquire properties to rapidly sell them for a profit, rather than utilize them as long-term investments or residences. This practice artificially inflates demand, resulting in increased prices. The competition for properties intensifies as more investors enter the market with similar intentions, further increasing the price of properties beyond the reach of ordinary purchasers. This speculative behavior has led to substantial price increases in numerous cities, rendering housing unaffordable for residents. Real estate speculation has resulted in housing bubbles that have the potential to collapse, thereby endangering financial stability in markets such as New York, London, or Vancouver. Decreased housing supply for homebuyers. The available housing stock for first-time buyers and long-term homeowners is diminished as speculators frequently acquire homes to flip or retain as investment properties. This trend is particularly problematic in urban areas where the housing supply is already constrained. The affordability crisis is further exacerbated when speculators hold multiple properties or keep units vacant in anticipation of the appropriate time to sell, thereby constraining the available supply. Housing as a commodity. Housing has been transformed from a fundamental necessity to a commodity due to the speculative character of real estate investment. The market is primarily motivated by short-term financial gains, rather than the provision of affordable dwellings for families and individuals. This change in perspective distorts the genuine purpose of housing, diminishing its status as a dependable long-term investment in the welfare of communities and individuals. Rising volatility. The housing market has experienced an increase in volatility as a result of the emphasis on short-term profits. The rapid buying and selling behavior of speculative investors results in unpredictable price fluctuations. In this type of market, prices may experience significant fluctuations in response to fluctuations in interest rates, macroeconomic trends, and investor sentiment. This volatility impedes the ability of purchasers and long-term investors to make informed decisions, resulting in potential market instability and uncertainty. Widening wealth gap. Wealthy investors who possess the capital to acquire numerous properties are disproportionately benefited by speculation in the housing market. The wealth disparity is exacerbated as middle and lower-income families are frequently priced out as prices rise. The increasing disparity between those who can afford to invest in property and those who are unable to find affordable accommodation has been exacerbated by real estate speculation. Obstacles to regulation. The housing market is currently experiencing adverse consequences as a result of speculation and short-term gains, which governments and local authorities are currently attempting to mitigate. Although some cities have implemented policies to discourage speculative purchasing, such as levying higher taxes on vacant properties or foreign purchasers, these measures frequently fail to address the underlying issues. The complex challenge of maintaining affordability for residents while also promoting healthy investment in real estate persists. In the aftermath of the Great Recession, there has been a significant amount of responsibility placed on low-income homebuyers. According to the narrative, they initially undermined the mortgage market and subsequently the entire economy by obtaining subprime loans for homes they were unable to afford. However, Michael Soaring identifies an alternative culprit at the opposite extreme of the economic spectrum when he examines that era. In recent research, the assistant professor of finance at Texas McCombs has discovered that well-heeled investors who inflated prices through speculation were a significant factor in the collapse. They acquired properties to resell them for a fast profit, rather than reside in them. Soaring asserts that the boom and collapse would have been approximately one-third smaller if speculation had not been present. However, he discovers that speculation did not merely distort housing prices. It migrated to other sectors of the local economy, initially increasing and subsequently decreasing employment, earnings, and expenditures. He cautions that the same cycle may recur in the present day. Markets in which residences are appreciating at a rapid pace are susceptible to speculative binges, which are subsequently followed by extended economic downturns. Soaring asserts that asset bubbles can have significant consequences beyond housing markets. They can have severe long and medium-term repercussions. Homeowners who do not reside in their homes. Soaring and co-authors Zhenyu Gao of the Chinese University of Hong Kong and Wei Xiong of Princeton University observed a remarkable pattern when they initially analyzed residential mortgage data for 3,935 zip codes. The percentage of home purchases that were not owner-occupied was the curve that most closely matched the rise and decline of local housing prices from 2000 to 2009. In hot housing markets like Las Vegas, the figures soared to 29%, even though the nationwide average was 14%. This indicated that a significant number of those residences were intended to be sold as investments in anticipation of further price increases. In the early 2000s, investment returns were low and interest rates were low. People sought an investment opportunity, and they opted to invest in housing. Michael Sorkin. Sorkin verified his suspicion by conducting a comparison of capital gains taxes in various jurisdictions. Non-owner-occupied homes were purchased at a higher rate in regions with reduced tax rates. This was consistent with his hypothesis that speculators would be more active in regions where they could retain a greater portion of their proceeds. He asserts that in those regions, they exert an excessive amount of upward pressure on housing prices, which exceeds their fundamental levels. He discovered that local expansions were exacerbated by speculation in the areas where it was most intense. Housing prices were 27% higher in ZIP codes, where the purchase of non-owner-occupied homes was 10% higher than the average. However, when crashes occurred, prices declined by a third more than the average locale, 37%. According to Sorkin, the extent of the decline was because speculators had artificially inflated prices. Increased booms, more protracted recessions. The repercussions of speculation extended beyond housing costs, affecting broader economies in both positive and negative ways. Employment rates in the same ZIP codes were 8% higher than the average during the growth and 15% lower during the bust. During the boom, per capita income was 14% higher, while during the collapse, it was 15% lower. Sorkin posits that the local economies were stimulated by the inflated housing prices as a result of the increased number of construction jobs and the increased number of individuals who withdrew money out of their homes through home equity loans. However, they also exacerbated recessions by causing a greater depletion of credit and construction employment than the average location. The recovery of those economies was also delayed due to the supply overhang of vacant homes. Sorkin asserts that if you construct an excessive amount during the boom, you're left with it during the bust. Over time, it is feasible to rectify household balance sheets. However, it is impossible to undo the construction of a home. Michael Sorkin. Sorkin is apprehensive about the emergence of new speculative bubbles in the current property markets. Over the past decade, prices have increased at rates that are more sustainable on a national scale. However, they are experiencing overheating in isolated locations, such as small villages where residents of larger cities have relocated to escape COVID-19 hotspots. He suggests that policymakers in those regions may implement measures to discourage speculation, such as increasing capital gains tax rates and restricting mortgage deductions for second properties. Speculators' enthusiasm may be dampened by such measures. If you reduce their returns, you decrease their appetites, Sorkin asserts. He suggests that lenders in these markets could contribute. Lenders may necessitate additional financial documentation and a larger down payment when a borrower purchases a second property. Conclusion: the necessity of long-term resolutions. To reestablish equilibrium in the housing market, policymakers, investors, and communities must prioritize long-term solutions over immediate benefits. By increasing the supply of housing, fostering sustainable development, and limiting excessive speculation, it is possible to guarantee that the market remains stable and accessible to all. The absence of such measures will result in the continued distortion of the housing market, which will exacerbate economic instability and inequality. If you found this content helpful, be sure to like the video. Subscribe for more insightful articles and updates. And don't forget to leave a comment below with your thoughts or any questions you may have. We love to hear from you.